In the study of corporate finance, we begin by understanding its core objectives. Corporate finance is the branch of finance that focuses on how corporations manage their funding sources, capital structuring, and investment decisions. At its heart, corporate finance seeks to answer three fundamental questions. Which long-term assets should the firm invest in? How should the firm raise the money needed for those investments? And how should the firm manage its day-to-day financial operations to ensure it can meet its obligations and create value? But beneath these practical questions lies a deeper set of objectives that guide every financial action a corporation takes. The core objectives of corporate finance are the foundational goals that drive financial decision-making, ensuring that a firm not only survives but thrives in a competitive environment. These objectives are not arbitrary. They emerge from the logic of financial markets, the behavior of investors, and the realities of running a business that has limited resources and unlimited opportunities. The primary and most widely accepted core objective of corporate finance is the maximization of shareholder wealth. This means that every major financial decision, whether it involves launching a new product, acquiring another company, issuing bonds, or repurchasing shares, should be evaluated based on its potential to increase the market value of the firm's existing shares. In practice, shareholder wealth is measured by the current market price of the company's stock multiplied by the number of shares outstanding. Therefore, when we say that a financial manager aims to maximize shareholder wealth, we mean that they seek to drive the share price upward over time, while also considering the risk that shareholders bear. This objective is often contrasted with profit maximization, which focuses only on short-term earnings. Profit maximization can lead to decisions that boost this year's profit at the expense of long-term value, such as cutting research and development spending or delaying necessary maintenance. Shareholder wealth maximization, by contrast, incorporates the timing and risk of expected cash flows. A project that generates stable, predictable returns over many years may create more shareholder wealth than a project that yields a large, one-time profit but is very risky. For example, consider a pharmaceutical company deciding whether to invest in developing a new drug. The drug might not generate profits for several years, and there is a risk that it might never be approved. Yet if successful, it could dramatically increase the firm's share price. A profit-maximizing approach might reject the project because of its initial losses. A shareholder wealth maximizing approach, however, would evaluate the present value of the drug's expected future cash flows, adjusted for risk. If that present value is greater than the development cost, the project should be undertaken even though it reduces short-term profit. This example shows how the core objective shapes real-world choices. To implement shareholder wealth maximization, financial managers rely on two supporting objectives: making sound investment decisions and making sound financing decisions. The investment decision, also known as capital budgeting, involves selecting which projects or assets the firm should acquire. The rule is simple in theory. Invest only in projects that are expected to increase the firm's value. This requires estimating the project's future cash flows, determining an appropriate discount rate that reflects the project's risk, and calculating the net present value. A positive net present value means the project is expected to add value to the firm. A negative net present value would destroy value. The financing decision, or capital structure decision, involves choosing the mix of debt and equity used to fund the firm's investments. Here, the objective is to find the combination that minimizes the firm's cost of capital while balancing the risks of financial distress. By lowering the cost of capital, the firm increases the net present value of its investments, which in turn raises shareholder wealth. For instance, if a company can issue bonds at a lower interest rate than the expected return demanded by equity investors, using some debt can reduce the overall cost of funding. However, too much debt increases the risk of bankruptcy, which can harm shareholders. Thus, the financing objective is to strike an optimal balance. A third critical objective, which flows directly from wealth maximization, is the effective management of liquidity and working capital. While long-term investments and financing structures are essential, a firm must also ensure that it has enough cash on hand to pay its bills, meet payroll, and take advantage of unexpected opportunities. This is the domain of working capital management, which involves managing current assets such as cash, inventory, and accounts receivable, as well as current liabilities such as accounts payable and short-term debt. The objective here is not to hoard cash, because excess cash earns a low return and could have been distributed to shareholders or invested in productive projects. Nor is it to run so lean that the firm risks insolvency. The goal is to maintain a level of net working capital that allows smooth operations without tying up unnecessary funds. For example, A retail chain must decide how much inventory to keep in its warehouses. Too much inventory consumes storage space and ties up capital. Too little inventory leads to stock-outs and lost sales. By carefully forecasting sales and managing supplier relationships, the retailer can minimize the cash conversion cycle, the time between paying for raw materials and collecting cash from customers. Shortening this cycle increases the firm's free cash flow, which can be used to invest in value-creating projects or return to shareholders. Thus, efficient working capital management directly supports the overarching objective of increasing shareholder wealth. Beyond the day-to-day management of cash and inventory, corporate finance also pursues the objective of risk management. Shareholders are generally risk-averse. They prefer a higher expected return for any given level of risk, and they prefer lower risk for any given expected return. Therefore, a firm that can reduce its exposure to volatile input prices, interest rate fluctuations, or currency exchange movements, without incurring excessive costs, will create value for its shareholders. Risk management does not mean eliminating all risks. Some risks, such as the risk of a new product failing in the market, are inherent to the firm's business and offer potential rewards. Instead, the objective is to reduce risks that shareholders could more cheaply diversify away themselves, or that do not offer any compensating expected return. For instance, an airline company is exposed to the risk of rising jet fuel prices. If fuel prices spike unexpectedly, the airline's profits and share price may fall. The airline can manage this risk by entering into futures contracts or buying call options on oil, effectively locking in a stable fuel cost. By doing so, the airline reduces the volatility of its cash flows and makes its earnings more predictable. Investors value predictability because it reduces uncertainty about future dividends and share prices. Consequently, a well-designed risk management program can increase the firm's market value, even though it may involve paying premiums for derivative contracts. This illustrates how risk management serves as another core objective, directly supporting shareholder wealth maximization. Another important objective, often implicit in the discussion of wealth maximization, is the maintenance of financial flexibility. Financial flexibility refers to the firm's ability to raise capital quickly and on reasonable terms when attractive investment opportunities arise. A firm that has exhausted its borrowing capacity or that has a poor credit rating may find itself unable to fund a positive net present value project, thereby losing value that its shareholders could have enjoyed. Conversely, a firm that maintains a conservative capital structure, with low debt levels and ample access to bank lines of credit, can seize opportunities even during economic downturns. For example, consider two competing technology companies. Company A has a debt-to-equity ratio of 30% and keeps a large cash reserve. Company B is highly leveraged, with a debt-to-equity ratio of 80% and operates with minimal cash. When a sudden technological shift creates a need for rapid investment in new machinery, Company A can readily borrow more or use its cash reserves to buy the equipment, capturing market share and boosting its share price. Company B, however, may be unable to obtain additional loans because its lenders are worried about its existing debt burden. Company B might be forced to pass on the opportunity, and its share price may suffer as a result. The core objective of financial flexibility thus reminds managers that aggressive use of debt can boost returns in good times, but can also limit strategic options in bad times. Striking the right balance is essential for creating long-term shareholder value. A closely related objective is the alignment of managerial behavior with shareholder interests. In large corporations, the managers who make financial decisions are not the same people as the shareholders who own the firm. This separation of ownership and control can lead to what is known as agency problems, where managers pursue their own goals, such as building large offices, growing the firm beyond optimal size, or avoiding risky but valuable projects, instead of maximizing shareholder wealth. Therefore, a core objective of corporate finance, from the perspective of the firm's board of directors and its shareholders, is to design compensation contracts, monitoring systems, and governance structures that incentivize managers to act in the interest of shareholders. Executive stock options are a common tool. When managers own stock options that become valuable only if the share price rises, they have a direct financial incentive to make decisions that increase shareholder wealth. Similarly, tying annual bonuses to measures such as return on equity or economic value added can help align interests. For example, if a chief executive officer's bonus depends on the firm's earnings per share growth, she will be motivated to seek out positive net present value projects and to cut wasteful spending. However, alignment must be done carefully to avoid encouraging short-term manipulation. A well-designed incentive plan focuses on long-term value creation, such as vesting stock options over several years or using performance targets based on multi-year average returns. This objective of interest alignment is not separate from wealth maximization. It is a necessary condition for achieving it in practice. All of these objectives, wealth maximization, sound investment and financing decisions, efficient working capital management, risk management, financial flexibility, and interest alignment, are underpinned by a few fundamental principles of corporate finance. The first principle is the time value of money. A dollar received today is worth more than a dollar received in the future because today's dollar can be invested to earn a return. Therefore, any evaluation of a project or a financial decision must take into account the timing of cash flows, discounting future amounts back to their present value. The second principle is the trade-off between risk and return. Higher expected returns are associated with higher risk. Investors and managers must evaluate whether the potential reward justifies the uncertainty involved. The third principle is that market prices generally reflect all available information. In efficient markets, the current share price incorporates the collective wisdom of many investors. Consequently, financial managers should not try to time the market or consistently outguess it. Instead, they should focus on creating real value through sound operating and investment decisions. The fourth principle is that the objective of the firm is to maximize its value, not to achieve any arbitrary non-financial goal. This principle guides managers to reject projects that might be socially appealing but destroy shareholder value. Unless those projects are required by law or are part of a well-reasoned corporate social responsibility strategy that ultimately enhances long-term value through improved reputation or employee morale. To see how these principles and objectives work together in a realistic scenario, imagine a medium-sized manufacturing company that produces industrial machinery. The company's shares trade on a stock exchange. The financial manager is considering whether to build a new factory. The factory will cost $100 million. It is expected to generate additional cash flows of $15 million per year for 10 years. However, the cash flows are uncertain because demand for machinery depends on the overall economy. Using the time value of money and a risk-adjusted discount rate of 10%, the manager calculates the net present value of the project. If the present value of the $15 million annual cash flows is less than $100 million, the project would reduce shareholder wealth and should be rejected. If it is greater, the project should be accepted. But the financial manager must also consider how to finance the factory. Should the company issue new shares or borrow the $100 million by selling bonds? Issuing new shares would dilute existing shareholders' ownership, but would not increase the risk of bankruptcy. Borrowing would preserve ownership concentration, but would add fixed interest payments, increasing the risk of financial distress if the economy turns down. The manager compares the cost of equity and the after-tax cost of debt, seeking the capital structure that minimizes the weighted average cost of capital. In addition, the manager must ensure that the company retains enough working capital to operate the new factory, buying raw materials, paying wages, and managing inventory. The manager might also consider hedging against a possible rise in the price of steel, a key input, by using commodity futures. Throughout this process, the manager's compensation includes stock options that vest over 5 years, aligning her incentives with the long-term share price. Each decision is evaluated against the central question: will this action increase the market value of the firm's shares? If the answer is yes, the decision is consistent with the core objectives of corporate finance. In summary, the core objectives of corporate finance revolve around one overarching goal: the maximization of shareholder wealth. This goal is pursued through a set of interrelated sub-objectives, including making value-adding investment decisions, choosing an efficient financing mix, managing working capital effectively, controlling financial risks, preserving financial flexibility, and aligning managerial incentives with those of shareholders. These objectives are not static. They evolve as the firm's circumstances change and as financial markets develop. But the fundamental logic remains constant. Every financial decision, from the most strategic merger to the most routine payment of a supplier, should be guided by the question of how it affects the long-term value of the firm as measured by its share price. By understanding and applying these core objectives, financial managers can allocate scarce capital to its most productive uses, reward investors for the risks they bear, and ultimately contribute to the efficient functioning of the economy. As you continue your study of corporate finance, keep these objectives at the forefront of your thinking. They are the compass that points toward sound financial management, and they will help you evaluate the endless flow of proposals, risks, and opportunities that corporations face every day.